Most people believe the wealthy pay less tax because they cheat the system. That belief is wrong. The truth is far more uncomfortable. The rich don't avoid taxes illegally. They understand the rules better than everyone else and structure their money to work with the tax code instead of against it. Every year, millions of middle-class earners overpay in taxes. Not because they earn more, but because they earn without a strategy. In this video, you'll learn the exact legal tax strategies high-income individuals use to save thousands or even millions of dollars, all while staying completely compliant with the law. These strategies aren't secrets. They're written directly into tax codes, IRS publications, and financial law. The difference is that wealthy individuals build their entire financial lives around them, while most people only think about taxes once a year. By the end of this script, you'll understand how money is taxed differently depending on how it's earned, how it's invested, and how it's passed on, and why the wealthy almost never rely on a paycheck alone. Let's begin with the most important principle of all. Not all income is taxed the same. The tax system heavily penalizes earned income, meaning wages and salaries. In the United States, earned income is subject to federal income tax, state income tax, and payroll taxes such as Social Security and Medicare. For high earners, the marginal federal tax rate alone can reach 37% before state taxes are even considered. The wealthy minimize this by shifting away from earned income and toward investment and business income, which is often taxed at much lower rates. One of the most powerful tools the rich use is capital gains taxation. Long-term capital gains, profits from assets held for more than 1 year, are taxed at 0%, 15%, or 20%, depending on income level. This is significantly lower than top ordinary income tax rates. That's why wealthy individuals prioritize owning assets such as stocks, private businesses, real estate, and equity funds. Instead of working for money, they let money work for them. Even more powerful is the strategy of deferring taxes indefinitely. Wealthy investors often avoid selling appreciated assets altogether. As long as an asset isn't sold, capital gains tax isn't triggered. This allows wealth to compound over decades without being reduced by taxes. Some investors borrow against these assets instead of selling them, accessing cash without creating a taxable event. This approach is fully legal and commonly used by ultra-high net worth individuals. Another foundational strategy involves business ownership. The tax code strongly favors entrepreneurs. Business owners can deduct ordinary and necessary expenses before paying taxes. This includes office space, vehicles used for business, travel, education, software, and even portions of home expenses through the home office deduction. Employees earn income first and pay taxes later. Business owners deduct expenses first and pay taxes on what's left. Wealthy individuals also strategically choose the right business entity. Structures such as S corporations, LLCs, and partnerships allow income to pass through to owners, avoiding double taxation. S corporation owners, for example, can pay themselves a reasonable salary subject to payroll taxes, while taking remaining profits as distributions that are not subject to Social Security and Medicare taxes. This alone can save tens of thousands of dollars per year for high earners. Retirement accounts are another major tax weapon. While most people are familiar with 401ks and IRAs, the wealthy use them far more aggressively and strategically. Contributions to traditional retirement accounts reduce taxable income today, while Roth accounts allow for tax-free growth and withdrawals later. High-income individuals often use strategies like backdoor Roth IRAs, which are legal methods of contributing to Roth accounts despite income limits. Wealthy business owners can also establish solo 401ks, or defined benefit plans, allowing them to contribute far more than standard retirement limits. In some cases, contributions can exceed $100,000 per year, dramatically reducing current tax liability while building long-term wealth. Real estate deserves special attention because it may be the most tax-advantaged asset class in existence. Rental income is often shielded by depreciation, a non-cash expense that reduces taxable income, even while the property may be appreciating in value. This allows many wealthy real estate investors to generate positive cash flow while reporting little to no taxable income. One of the most powerful real estate strategies is the 1031 exchange, which allows investors to sell a property and reinvest the proceeds into another property without paying capital gains tax at the time of sale. This can be repeated indefinitely, allowing wealth to grow tax-deferred across multiple properties and decades. Even when real estate is eventually passed to heirs, another major advantage comes into play: the step-up in basis. When an asset is inherited, its cost basis is reset to its market value at the time of the owner's death. This often eliminates decades of unrealized capital gains, meaning heirs can sell the asset with little or no capital gains tax owed. This single rule is one of the most significant contributors to generational wealth preservation. Charitable giving is another area where the wealthy combine generosity with tax efficiency. Donations to qualified charities are tax deductible, but the wealthy often donate appreciated assets instead of cash. By donating stocks or other assets that have increased in value, they avoid capital gains tax while still receiving a deduction for the full market value. More advanced strategies involve donor-advised funds, which allow individuals to make a large charitable contribution in 1 year, taking the full deduction immediately, while distributing funds to charities over time. This is especially useful during years of unusually high income, such as the sale of a business. The wealthy also make strategic use of losses through a practice known as tax loss harvesting. Investors sell underperforming assets to realize losses that can offset capital gains elsewhere. If losses exceed gains, up to $3,000 per year can be deducted against ordinary income, with excess losses carried forward indefinitely. This strategy is widely used by hedge funds and high net worth investors to smooth tax exposure over time. Another underappreciated strategy is income timing. The wealthy often have control over when income is recognized. By deferring income into future years or accelerating deductions into the current year, they can reduce taxes during high income periods. This level of control is rarely available to salaried employees, which is why business ownership plays such a central role in tax planning. Family-based strategies are also common. Wealthy individuals may employ family members in their businesses, shifting income to lower tax brackets. They may also fund education through 529 plans, which allow investments to grow tax-free when used for qualified education expenses. Some states even offer additional tax deductions or credits for contributions. Trusts are another powerful but often misunderstood tool. While trusts don't eliminate taxes, they can control when and how taxes are paid, protect assets, and reduce estate tax exposure. Irrevocable trusts, grantor trusts, and charitable remainder trusts are commonly used in advanced tax planning to move assets out of taxable estates while still benefiting family members or charities. Estate taxes are a major concern for the ultra-wealthy, but even here, the tax code provides planning opportunities. As of current law, the federal estate tax exemption exceeds $12 million per individual, meaning most estates owe no federal estate tax at all. Wealthy families use lifetime gifting, trusts, and valuation discounts to further reduce exposure. It's important to understand that none of these strategies are loopholes in the illegal sense. They are intentional incentives built into the tax system to encourage investment, business growth, home ownership, retirement savings, and philanthropy. The wealthy simply structure their lives around these incentives, while most people are never taught they exist. The biggest difference between those who overpay and those who don't is education and planning. The wealthy don't wait until tax season to think about taxes. They plan year-round, working with accountants, financial advisors, and attorneys to ensure every dollar is positioned efficiently. Taxes are treated as a controllable expense, not an unavoidable punishment. That doesn't mean these strategies are only for billionaires. Many of them are accessible to anyone willing to learn, plan ahead, and think differently about income and wealth. Even small changes, like investing instead of saving, Starting a side business or contributing strategically to retirement accounts can compound into massive tax savings over time. The tax code rewards behavior, not effort. It rewards ownership over labor, planning over reaction, and patience over immediacy. Once you understand this, you stop asking why the rich pay less tax and start asking how you can legally do the same. If this breakdown helped you see money and taxes in a completely new way, imagine what consistent knowledge like this could do for your financial future. Subscribe to the channel for more real, practical insights on wealth, investing, and financial strategy. Because the rules of money don't change, but who understands them does.